Today, the entire show is getting expert advice from a tax expert. Yeah, the big, beautiful bill just passed. And there are some things in there that are going to be advantages for first-time home buyers. I myself am not a tax professional, but I've been talking to people about the tax benefits of home ownership and encouraging them to talk to a tax professional, but not just any tax professional, a tax professional that has unicorn type traits. Now, I've been doing the show for 6 years. I've got so many people pestering me all the time that want to come on the show or they want to advertise on the show and they want to talk to you homies. Well, for me, they've got to have the right heart. Now we add on to that the expertise and then one more layer of someone who really understands what they do for first-time home buyers. And today I've got one of the co-authors of the book that I've been talking about on the podcast, Real Decisions. This is Dan the Tax Man. I just called him that and he probably hates me. This interview has everything about the big, beautiful bill. And real importantly, we're also going to talk about self-employed people. So many times self-employed people think that they can't buy a home. And the reason is because they think they don't look good on their taxes. Dan and I get into that and so much more. Here comes the interview.
How to Buy a Home educates, protects, and connects first-time homebuyers to qualified vetted realtors in their area. Whether you're looking for DIY information or step-by-step guidance, How to Buy a Home is the #1 resource for first-time homebuyers.
What is happening, my How to Buy a Homies? I am so pumped for today's episode. 6 years of doing this, haven't had a tax person on. Part of that's because the tax laws change everywhere depending on what state you're in, or I don't know what you loonies in Canada use. That's not a slur, folks. That's their money. But the reason why I haven't is because, and a lot of the CPAs out there, they're not focused on home ownership. Being a tax man is getting people back as much money as they can, which is fantastic, except then your tax returns look crappy when you go to a mortgage person to try to get a loan. I can tell you right now, there are 3 deal killers in every first-time homebuyer process. Not someone, trying to sell a home, but for first-time homebuyers. When your dad comes to the inspection, that almost always kills the deal. When you talk to a financial advisor who thinks it's a better idea to put all your money in stocks and make 8%. Meanwhile, you stay renting for 5 years at $25,000, $36,000, $48,000 a year. Or the tax pros, the CPAs. So many times they will end up screwing up deals because they're not looking at the full picture. Well, I've got Dan Mullen, who was on the podcast. I'm actually recording this the day his first episode drops. He's the co-author of Real Decisions, this book right here, which I am so excited. Dan, you just told me this book is going to audio. So my listeners are going to be able to find this, right?
That's right. Yeah, we're going to record it this weekend. I don't know when you're going to release this podcast. It may well be out by the time this podcast is released.
Awesome. Well, I will definitely make sure I let all the listeners know because there are lots of great resources out there, but I'm telling you, if you're looking for the why, if I'm wearing my Believe t-shirt today, if you're looking to believe and you don't want platitudes, you want numbers, this book is so filled with graphs and numbers and details because it comes to you from Dan and his brother, and his brother's financial advisor, and Dan is the CPA. So today, we're going to talk everything taxes for homeowners. We're going to talk about all the new things that came with the big, beautiful bill. And there is some stuff in there that does benefit first-time home buyers. And we're going to talk about some of the things that first-time home buyers haven't been taking advantage of and that are still available, whether they were altered in the bill or didn't get touched at all. And my most exciting thing about today, wow, that's a sentence. The most exciting thing about my interview with Dan today is we're going to talk about self-employed people. How do self-employed people make their taxes look like, you make money, you can buy a house. And as a dude who's been a 1099er since, 1990, I completely understand your pain. Dan, welcome to the show today.
Thanks, David. Good to be here.
I'm super stoked. Dan and I, he's not just a guest on the show today, but he's become one of my colleagues. We mastermind all the time and talk about this stuff. So we're just going to zip through a whole bunch of stuff. Now, here's the deal. If you've got questions that are deeper than this, you can reach out to me. In the show notes, we're going to show you how to get in touch with Dan as well. But I have never met a tax consultant who is more geared to the real estate side of doing your taxes. So we're going to zip through a whole bunch of things. Now, we had the big, beautiful bill that passed. But before we get into those benefits, I wanted to talk what led you into this emphasis on real estate being something that you wanted to make sure people had the right tax education about.
So, I mean, there's some pretty awesome benefits in the tax code for real estate investors, right? I mean, it's not that difficult if you know what you're doing on the tax side to zero out your taxes for pretty well earning, real estate agents, contractors, real estate investors, plumbers, electricians. There's kind of a certain class in there called the real estate professional status that I can do a lot of damage if you have real estate investing. And I recognized the more I got into real estate, the more I wanted to understand the financing side of it, meaning the mortgage side of it too. And I realized as I was preparing tax returns, I'd get some odd requests from mortgage lenders saying things like, "Okay, we need a letter to, have some kind of assurance that the buyer here can buy this home, financially speaking." And some of the requests are pretty ridiculous and things that I couldn't answer because I'd only prepared a tax return. I didn't do a full scale audit on that person. To make a long story short, though, I recognize that there are things that you can do. I picked up my mortgage license to deeper understand this, and I'm only licensed in a couple states. I'm like 99% CPA. And so I just have a mortgage license really to understand that. And what I found is there are ways and levers I can pull to make you look poor to the IRS and rich to a lender. And that is pretty dang key to helping self-employed people qualify.
That is the key. When we first started talking about this, and I can't remember if I read it in the book or you and I were just talking about it, but poor to the IRS and rich to the lender. If you're new to this game and all this is confusing and you're just looking for tax tips, let me tell you, all the little tips you can Google all day long pale in comparison. They're 1/100th of the tip that he just gave. Having your tax person make your return look like you can get a loan approval. That's the number one thing. And then what happens is most people, when they do that with a CPA that isn't really concentrating on both sides of it, well, then they end up either losing too much money annually and they're not, at that point, they're showing this huge amount of money that they made, but then it's costing them dearly because they're paying a ton. And in the situation that you're in right now, what you've done, knowing both sides of the puzzle, thing that was really interesting to me when we started talking about this was you said that there are a ton of tax benefits for first-time home buyers, but you said you think a lot of realtors and lenders are kind of overblowing it. And, in some correspondence we had, you said tax benefits shouldn't be the reason you buy a home. Explain that.
Right. And something I tell to a lot of my tax clients is don't let the tax tail wag the dog. Right. There are some certain home benefits to buying a home. There's certain tax benefits in there for dang sure. But I mean, you have to make that as part of your decision and not the driver for your decision. Now, some tax that can work for investors, but we're not talking about investors. We're talking about first-time home buyers here, to where, yeah, there are some tax benefits in there, but it's not like a life-changing amount for most people. Um, Things like mortgage interest, property taxes, being able to write that off, that probably doesn't change your world, by replacing a salary amount of your wealth, right? But it's going to
Yeah.
have something in there. And if you're doing calculations, you're doing math, like I know you love doing, David, which is why I'm so drawn to you, is, we put that as part of your equation because it's not nothing.
Well, and that's the piece of the puzzle right now. People are looking for the piece of the puzzle. Rates are 7% right now. When rates get to 6.2, I can afford this. Okay, well, how much is that in the difference in your monthly payment? Well, yeah, it's that $500 difference. That'll make the huge difference for me. A lot of times you can find that difference in your tax benefits. And especially with some of the things that have happened with Big Beautiful Bill, and we'll get into that in a second. But I like what you're saying. Tax benefits of buying a home is not the thing that's going to make it cheaper than buying your rent. It's a single variable in the equation that's going to create affordability. So, all right, I've read so much about this bill, so let's get into it. The first thing that we talked about for the bill and some of the changes probably is one of the biggest for me, because I've been talking about the mortgage interest deduction for years. And back before 2017, 2018, when the standard deduction started, I was talking to people all the time about using their mortgage interest as a deduction on their taxes, because it was going to be a huge way for them to have this giant tax break. So give us the update on the standard deduction and what the changes are going to be happening.
So the standard deduction it encompasses things so fewer people have to itemize. I think it was a play for the IRS and administrative bodies and the government to, decomplicate, if that's the word, to simplify, right? Goodness, to simplify, the tax filing process. Itemizing can take a lot of paperwork, and if it ends up in an audit, it's just a little more hair that it adds to the entire return. And so it does actually help a lot of Americans too lower their overall tax bill. And so when the standard deduction essentially doubled in 2018, it kind of put a little bit of a damper on the mortgage interest deduction. For a little bit more context, you have a choice to either itemize your deductions or to take the standard deduction. And itemizing your deductions, you can add up all these itemized deductions, what they call them. And if it's more than the standard deduction, it's going to benefit you on your taxes. So let's do the itemization method. One of those itemization methods as part of that is mortgage interest. And so if your mortgage interest doesn't eclipse that standard deduction for whatever that is for you, either as a single filer, head of household, or married filing jointly, then it won't really have a tax benefit at all, because it's kind of included in a standard deduction, which you would take as a renter or an owner anyway.
Okay, let's break that down and look at the numbers to kind of for folks who've never had to do this before. What's the standard deduction currently?
So with the one big beautiful bill, that inched it up a little bit. For a married couple, it's $31,500. It was going to be $30,000, but $31,500.
Okay, so if you're buying your first home at $400,000 and it's costing you, and I think it might be around 28 full PITI, but let's call it 3,000 right now.
Mm-hmm.
So on, let me pull out my handy dandy mortgage calculator here. Because if we're pulling on a $400,000 home, you're paying $3,000 a month. But at the beginning, much of that is going to be interest. So you're looking at $2,700 a month with your payment, with your interest at $1,800. So if we're doing 1,800 times 12, then I am a math guy, not so much a math guy in my head.
21,600.
How much, sir?
21,600.
Okay, so that's still going to be below our mortgage interest rate or our standard deduction.
By itself. Yes.
Just by itself. So how would that benefit the people who are with this new deduction, the new standard deduction? How could people use the mortgage interest on and then add other things on top of it? Is that what they would do?
Yes. So things like property taxes, which you're going to be paying as a homeowner, contribute to that too. So if you have an extra $5,000 in there in property taxes, that's what, 26.6 now. And then if you have state taxes on top of that for your wages, for your job, or for your income as a small business owner, you're going to have state taxes on that too. And that's going to vary across the board. Some states don't have a state income tax like Texas, and some have very high state taxes like California, to where, okay, those taxes that you've paid to the states will contribute towards this itemized deduction. So if that's high enough, that could get you over that 31.5. Or if you're single, by the way, we didn't mention this, but it's pretty important for somebody who is single, it's only 15,000. So, it's the mortgage interest alone, if you have the income to buy a $400,000 house, you're going to eclipse that $15,000 of interest you've paid. So,
So if you're
that
looking,
comes into factor with the state taxes and property taxes. Those are the main three things. Sometimes you'll get local and city taxes in there, but they don't move the needle very much. But all the state and local taxes, what SALT stands for, those are part of the itemized deduction that goes to the SALT. So that can definitely help.
yeah, like we're about 1.25% annually here in California is where what they do most of it. I know Jersey's over like 2%. So if you're looking at a $400,000 or $500,000 home, you're looking at $8,000, $10,000 a year that are being paid in taxes. So the deal is, a lot of people who own a home might just say, okay, I'm just going to take that $15,000, that $31,500, and boom, that pays for it. But if you have things you can itemize, and I'm assuming there are other non-real estate things that can become part of your itemized taxes too, correct?
You bet. Yep. Charitable contributions are in there. Let's see. Sometimes medical expenses can enter the fray in there if they're high enough. Yeah, there's a handful of other things that can contribute to itemizing for sure.
And we'll get deep into that when we get into the self-employed stuff, because that's a whole different world when, you're writing off, all kinds of different things. Okay, so this change in the big, beautiful bill, the standard deduction moved a little bit, but I guess what we're saying is, what were the additions in the big, beautiful bill that gave us more to write off? One of them was my most exciting thing, was PMI, but we'll get to that in a minute. But talk to us about SALT, because if you're a first-time home buyer and you keep hearing SALT on the news, you must be as confused as I am. So I'm going to give the worst dad joke ever, and I'm going to ask you to pepper us with the information about SALT.
Well, SALT, again, stands for state and local taxes, and that is part of your itemization equation. It used to be if you had $10,000 in state and local taxes, be it between your property taxes and your state income taxes, you had a limit of up to $10,000 to where if you had more of those taxes that you paid during the year, tough luck, you can't write them off. If you had fewer than that, cool, you're under that cap. That cap with the one big beautiful bill has increased from 10,000 to 40,000. So people in states like California, New York, where they have high incomes, they're paying a lot of state taxes, they're going to run up against that. That's a good thing for them, for high income earners who are paying those taxes. So that gives you more room to itemize and more reason to itemize, perhaps, if it adds up. But you have more in there that could contribute. As a homeowner, again, the big thing there is property taxes, which that's part of those state and local taxes. So that could be kind of nice.
That's huge because, like, let's say we're talking about Jersey. Their taxes are somewhere over 2%. And, homes are expensive there, so you get a $600,000 house. I ran the numbers for how much interest you pay, $1,800 for $400,000. So let's call it $2,500 in interest that you would be paying on a $600,000 house. Well, so that's 12 plus 6, that's $18,000 in interest. Well, that's still below the standard deduction. Well, thanks to this new SALT, you used to only be able to take that from 18 plus $10,000 for SALT. So that would have taken you to 28. But now in Jersey, your whole SALT liability might be $20,000.
Right.
So now you can take that 18 and you can take it up to 38, and suddenly itemizing your taxes is a much more lucrative way to do it than just taking the standard deduction.
Indeed. Yep, that's exactly right.
Nerds, stay with me. And non-nerds, you need nerds to break this stuff down for you. In the old days, the mortgage interest tax deduction was the simplest way for me to explain to people, hey, this is a giant benefit. But that's one of the things that we do here. And that's why I love talking to Dan so much, because we're not blowing smoke. We are telling you, we're not telling you, buy a home. It's a giant tax benefit. You'll save tons of money. But when you talk to someone like Dan who understands all this, they can get you through and give you the things that work specifically for you. Now, I love the fact that you got your loan license as well to figure stuff out like this. One of the things you told me was that buying points down on a loan is tax deductible.
That doesn't change either with the one big beautiful bill. If you want to get specific to the one big beautiful bill, it retained the idea that you can write off points in mortgage because that's part of your mortgage interest. It's one of the boxes in your form 1098 if you want to get nerdy about it. But
Yeah.
that remains deductible and will contribute towards your mortgage interest deduction. So
Okay, simplifying that. So that's going to be one time the first year, because you're going to, if you did like a 3-2-1 buy down, the payment for it is up front when you purchase the home.
right. The 3-2-1 buy down isn't mortgage interest that you're paying necessarily because that goes straight to escrow. But if you're doing a permanent buy down, a permanent reduction in your rate,
Okay.
you're buying points. Those contribute towards your interest deduction. Yes.
Okay. So, and that's what a lot of people, I tell people all the time, the hardest, most difficult time to pay your mortgage is going to be the first 2 or 3 years that you end up paying it. So any deduction. So what about other deductions that happen? If someone purchases a home here in 2025, what are some of the one-time tax deductions that they get that are going to probably most definitely help get them over the standard deduction so they can get more back?
Well, I know you wanted to talk about PMI, and that's kind of the one that's dangling left here. And so
Yeah.
private mortgage insurance, and we talked on our podcast, and I even have a chapter in the book about mortgage interest. I'm a huge fan of it, and that sounds so weird to most people. I'm not a fan of, the monthly payment attached to it. Other than you have to looking at it from a whole, it allows you to buy a home with less than 20% down. So yes, I'm a fan of that because the cost of waiting and renting and saving until 20% far eclipses the cost of private mortgage insurance in almost every case. And as a bonus now, with the passage of the one big beautiful bill, that is actually tax deductible now. That's part of your itemization. The private mortgage insurance, whatever those premiums are, some lenders allow you to pay that up front. So that could be a one-time boost to your itemization. Sometimes you just pay that monthly and you get that whatever you paid that year in private mortgage insurance is deductible as an itemized deduction. So yes, I'm a big fan of that.
Yeah, it's funny. Years ago, I did my podcast called PMI as a Privilege, helping people in Southern California find creative ways to buy a home so they're not wasting their time, creating that rent replacement strategy, because around here it would take people 5, 6, 7 years to save up the 20%.
At least.
And I thought I nerded out. And then I read you and your brother's book, and you guys have charts and graphs and math. And I was just part of the reason why we're such good pals now. Understanding that piece of the puzzle can be a real privilege, and the long-term math works for you. So for the first-time home buyers, if you pay it all up front, this can be a big relief the first year that you own your home, or maybe the second if you buy late in the year. That you're going to be looking at a large deduction because that PMI payment went immediately, and it's going to be on your next year's taxes because you paid it up front as part of that big purchase of the home. Now, if your individual payments are deductible thanks to the new tax bill, well, that means that everyone who's whining about it, sorry, I'm empathetic. I understand your situation. Everyone who is doesn't think it's a good idea because it doesn't make any sense to pay more money. Well, now it's tax deductible. So all the PMI arguments should be off the table. Am I right on that, Dan, or am I oversimplifying it?
Well, that probably oversimplify it because like I said, you don't want to let the tax tail wag the dog. So
Ah,
whatever your marginal tax rate is, you get a discount on that on your tax return if you itemize. So if you're in the 24% bracket, whatever your PMI, premiums are, then, take that times 76%, for example, and that's the after-tax effect of what you're actually paying for that.
so if your PMI is $100 and you're in the 24%, you're paying, or your
76.
deduction is.
Yeah, 24. Essentially you deduct the whole thing on your taxes, but it washes out to be, whatever that is times 76%.
Cool. Cool.
That's what your
And
actual
then,
payment's going to end up being. So,
yes. And yeah, so you're it's not dollar for dollar. It's, a $24 a month times 12, and that's what you're not paying. So then when we're looking at the actual one-time buying a home, where do moving expenses and realtor fees and escrow or title fees, where does that come in from the tax world?
So it actually isn't deductible in the year that you buy the home. However, you still want to keep track of it because when you sell that home, you're going to have capital gains calculation enter the fray. You're going to have, okay, if you bought a home for a low price and you sold it for a high price, which is extremely common, especially if you own that home for any amount of time, longer than a year or two, then you're going to have capital gains tax calculated. Now, if that's your personal home, you get an exemption amount for that. So it's, there's a big portion of that won't count. But if you're above the exemption, which is 250,000 if you're single and 500,000 if you are married filing jointly, then you're going to have some capital gains tax on it. And you're going to want to minimize that. It could be 15 or 20% usually is what those capital gains taxes end up being. You're going to want to mitigate that. And when the time to mitigate that is when you buy your home, you're going to have the settlement statement, you're going to have realtor commissions in there, you're going to have maybe some loan costs in there perhaps. That's more applicable to investors, I suppose. But yeah, selling commissions, sometimes escrow fees, they will increase your basis if we want to get nerdy about it. Long story short, it lowers your capital gains tax when you sell the property. So you don't get that as a deduction the year you buy the home, but you keep track of that stuff. And when you sell the home, that will have an effect. So keep track of those. Keep your closing statements when you purchase a home. Also, keep your renovation invoices because that will help in the same context. So if you remodel a bathroom or add new carpet or pour a foundation or redo a driveway, some major renovations, your roof, those kinds of things, you replace those big ticket items, keep track of those invoices because that can help lower your capital gains taxes upon the sale. Again, not a benefit when you're buying the home in that year, but it certainly has a tax effect when you're selling the home.
This is gigantic. I tell all my first-time home buyers, we spend a year working on a rent replacement strategy and then getting a last lease ever program together where they're working on their credit score, their debt, and their savings. So we have spreadsheets coming out the wazoo. And then as soon as they close, I've told every buyer for 20 years now, take before and after pictures of every single renovation and keep every receipt. Now, it might not mean anything to you today, and truly, it's not going to. In fact, it might make you cry when you realize how much you paid. But keep all of that because down the line, what Dan's talking about is if you buy a home for $400,000 and then you sell it for $800,000, well, that $400,000 profit, if you're a single person, $250,000 of it has no tax on it, thanks to the capital gains exemption. But the rest of it, the other $150,000, you're going to get taxed on. So if you can show where you've increased the value in the home, then that's going to, as Dan said, increase your base. Not to mention, gang, with refinancing and anything else that you want to do down the line where you might need an appraisal on the home, this is crucial to have this. So little sidetrack there because it's something that I love. I want everyone to understand every single project, and especially if insurance takes care of it, you still want to get it and still want to have it.
Side note, real quick on that note, if you're getting rid of PMI early, the appraiser might ask you, it usually requires an appraisal or somebody from the lender to come out and say, you can get rid of PMI because your property is increased enough, your equity position is great. They're going to ask, okay, what kind of improvements have you made to the property? If you can document that with your receipts and pictures, it's going to help them and your value is going to increase, which might give you a better chance of getting rid of your PMI.
It's so nerdy and in the weeds, but if you buy a home and you put 10% down, you're basically waiting to get 10% of equity in the home so that the value of the home now is 10% more, because then you cross that 20% threshold line where you can get rid of the PMI. I know some people that will put 10% down, even though they had 20%, because they're going to take that extra cash that they didn't use in their down payment and immediately do a big full kitchen remodel. Well, if you do that, the home's value might go up $25,000. You could be looking at removing your PMI as quickly as your lender will do it. I think it's 6 months or a year, depending on what kind of loan you get. Okay, I know that some people might have seen this, and we've got a lot of people who are looking at all the green stuff with homes. The solar panel piece, it looks like they've got a clock on it. It's usually a deduction. Talk to us about that, Dan.
So yeah, it has a clock on it now, and I think there's some awesome solar credits you can get for putting solar panels on your house and installing energy efficient furnaces and air conditioners, those kinds of things. I believe the Biden administration wanted to subsidize that a little bit, and so they did so in the form of some tax credits. Those are going away after December 31st of 2025. So if you're going to buy some solar panels and you want an extra, tax credit on top of that, you better do that and close and get that installed before December 31st, because that is going away.
So now a lot of people are going, cool, but what does that have to do with first-time home buyers? Here's what it has to do with first-time home buyers. This all goes together. I know it can get complex, but I'm doing my best to give examples and help break it down. Imagine this. You've got 25% down on your $500,000 home that you're going to purchase. You then go back and listen to some of the podcasts where you find low down payment options so you can keep more cash. Now, it's going to raise if you drop from putting 25% down to putting 10% down or 5% down. It's going to raise your monthly payment, but you have a giant chunk of money in a savings account, and you can draw from that money to make up the extra $600-700 a month that the new higher loan amount plus the PMI is going to cost you. Well, now what we've just said is so that PMI could potentially be a tax deduction. And you also can use some of that cash, if solar is in your future, to do that now. So you're thinking, Sidoni, relax. I just want to buy a home and put as much money down as I can. That's why you listen to the podcast. We're letting you know if you have all these creative ideas in front of you before you ever walk through an open house, suddenly you can decide to put less down on the home and take advantage of tax deductions like this, if that's something that you're thinking about. Okay, something else that we talk about on the podcast that you wanted to discuss with our homies here today, from the CPA perspective, talk to us about using your IRA and your 401k as a strategically smart move when you're looking to purchase your first home.
Yeah, I find it interesting that financial advisors have a hard time doing this math. And this is a piece of my book too, or our book, where we talk about, hey, taking money from your 401k. I don't think you're robbing from your future. In fact, I think I listened to one of your episodes where you're talking about, no, it diversifies it and enhances it. My approach on this is, number one, you're getting rid of your rent payment, and no financial advisor or no financial guru ever accounts for that. I don't know why. They right? They think, okay,
preach it to the choir, bro.
Yeah, right.
I don't get it. I mean, that's why I was so excited when I found you guys. I was like, this is a real advisor. So yeah, no one talks about it, dude.
And the math plays out. My approach is the math plays out to where if you borrow from your 401k, the return, and you put it down on a house, and you use that money to put down on a house, and that unlocks home ownership for you. The equity stake where you're growing is probably almost, I mean, if it even appreciates at 4%, which is very, very, very conservative in most places, that because it's leveraged with a mortgage, your return on the money you're taking out from a 401k probably blows away whatever return you're going to get in your 401k, leaving it in there. Because I mean, last time I calculated, it was close to like 70-80% from of a rate of return on certain dollars. Now, in my book, we're a little more conservative because we have all that calculation in there as far as,
yes,
okay, you don't have to pay rent now. What is that worth? And that comes a little bit closer to 39%. But man, you get a financial advisor suggesting that you can get 39% in your portfolio. That's not only you're not going to hear that. They're going to protect their license because that is extremely aggressive. However, the math works on buying your home and home ownership and having that as an equity stake in your personal home rather than in your 401k sitting in the S&P 500, which I'm a fan of, by the way. But if you're not a homeowner, use that to increase your overall net wealth. I mean, people talk about, your home isn't an investment. I disagree because it sure acts like one.
It absolutely does. And, it's funny. You and I are sitting here talking. I've talked about the diversification of your portfolio for years. I just realized math I've never said out loud on the podcast. So if you have $100,000 in a 401k and your financial advisor is telling you you're making 8%, first of all, the stock market is headed for something sometime. We're in the longest bull market in history. So if you're extrapolating that over the next 10 years, I'd be careful. But let's say it's 8% on $100,000. 8% on $100,000. Well, what if you took $50,000, the maximum that you could,
Right.
to buy your first home? I've already talked about how your rent is just lost. And if you're using that, how that changes the numbers dramatically. Okay, so now you're making 8% on $50,000, but you're making 4% on a $500,000 purchase. So I can't believe I've never said that math before.
Yeah.
So, and I'm just so focused on the rent replacement strategy that boy, there's a simpler way I could explain this to the CPAs. Now, you mentioned to me that in the past I've talked about borrowing from your IRA, and that's the wrong terminology. It's taking a distribution. Is that right? Am I saying that right now, Dan?
Yes, you can borrow from your 401k up to 50% of the value with a cap of $50,000 without any kind of tax penalty. You cannot borrow from an IRA. You can have a distribution of up to $10,000 that is tax free if you use that to buy a home, or if if you have parents who do that move, they can do that for a blood child or a stepchild. They can do that too. Like they can pull that out
Wait, wait,
without the
wait.
10% penalty.
So if parents have an IRA, they can do a one-time $10,000 to a child or stepchild for the purchase of a primary residence?
They can, yes, and it'll have taxes on it if it's a qualified IRA. But they will not have a penalty if they take it out if they're 59 and a half or younger. There's normally a 10% penalty for taking a distribution. This is a one-time exemption because somewhere in the tax code, somebody who was writing that piece decided that home ownership was a good idea, and I agree. And so they're
Yep.
subsidizing that by waiving that penalty on that $10,000.
So it's a taxable event, but a non-penalty event.
Correct.
And with the 401k, is that non-taxable?
Yes,
Or
that's non-taxable because you're borrowing money from yourself. That's not a distribution. That's not income. It's not taxable because you pay it back to yourself.
and no penalty. I cannot say it enough, gang. Right now in 2025, affordability is difficulty. By doing the safe thing, you end up spending way more money in rent, and you're watching the homes go up in value while everyone's sitting to see what's going. It just mathematically, I've talked about this 1,000 times on the podcast. These are two conservative people coming at you with this. Neither one of us wants to be your realtor and sell you a home tomorrow. No one's trying to push you into it. We're just giant nerds who have done the math and understand how beneficial home buying can be. So that 401k thing is gigantic. Now I want to get into something that is the passion. Because as a self-employed person for 30 something years now, you and I have talked about this. Dan, talk to us about your mission to help self-employed people get the benefits of home ownership and the things that to bust the myths that are making people think you need to be a W-2, W-4 earner and making six figures to buy a home. Self-employed people just can't do it.
You've talked numerous times about self-employed people on your podcast, and man, I love what you're preaching about that. To your point where you talked about how so many CPAs and tax preparers have one and only one focus, and that is to lower my taxes today. Some of them who are more advanced do some more future planning. I know a lot of the good ones will do that, but so many of them miss the idea that, okay, what are the effects that my tax return is going to have outside of my tax bill? And they're enormous. Qualifying for a home is one of the biggest, most common ones where I see people who say, yes, I'm self-employed and my tax returns kind of screwed me out of getting a conventional mortgage. Now, there's something that needs to be said about that, because when you're self-employed, you can still get mortgages if you have healthy income, although your tax return says you don't. And those are called bank statement loans, or sometimes they're called 1099 loans, where you can get loans based on what's showing in your bank statement rather than your tax return. However, what are those interest rates like, David?
Yeah, no, the bank statement interest rate loans are not optimum. How's that?
Right. Yeah, I mean they're
They're
often,
usually
it's not
high.
unheard of to see someone get one that's 2% higher of an interest rate than a conventional loan.
But I think the myth that just gets busted immediately is um, the fact that there are programs that do this. There are people that even though maybe, and I say this, understandingly, that I was ignorant as well about this. If you did your taxes wrong last year because you were trying to write everything off so that you didn't have to pay as much as a self-employed person, even if your taxes are wrong last year, there still are programs to get a loan.
Right.
So then that's where you come in, and what do you do to help shape things? So what did you say? So you look poor to the IRS and rich to the mortgage broker?
Yeah, and I should have an asterisk there, to rich enough to a mortgage lender, right?
Yes, exactly. Yeah.
So,
Yep.
yep, rich enough. So, yeah, to your point, yeah, bank statement loan, you can get those. And sometimes that's where we start, because somebody found their dream home and they have plenty of income on a bank statement basis to afford that. And knowing that, okay, we're going to address our tax returns so that next time or next year, we can file and get a conventional loan. We can refinance into a conventional loan. That's not unheard of, especially if you find, hey, that's the house I see myself, I have to have it. I'm willing to pay a 2% higher interest rate, or 1.5, whatever that ends up being, and then work with me to get a conventional loan. So,
So using the bank statements where you show less, you get a higher rate. Now, once you get
well,
the
no, where
loan,
you show more higher income on a bank statement than your tax return leads on.
yes, yes. So you show less on your tax return
Correct.
at that point. So if you're showing less on your tax return and you want to buy now, you either have to go back and redo your taxes to show more, or do this. You don't? Okay. Then, so my point was,
It's
you got
it's
my brain.
nuanced. We'll get there. Go ahead.
Yeah, okay. So what if you did this, you took the 2% higher rate, and then you went back to being a self-employed person? Once you own the home, the loan's done. It's in there. Now, for the next couple of years, you go back to your old ways, and either you can go back to your old ways and make more money and not pay as much to the IRS, or you could continue to do that, or show more for the next couple of years, and then potentially be in a position to refinance. Is that something that's logical? Sorry, my real estate brain got going.
Yeah, no, yeah. Why I was shaking my head? Let me get to that first, because it's pertinent. Um, if you, so let's say you, in reality, you made 200,000, but your tax return shows you making 50,000 because you're trying to write stuff off. Legal or not, I'm not going to go there, and I certainly don't make assumptions or judgments
Yep.
for people doing that. Right? I'm not
Yep.
going there. But yes, you can do that, and
You can
if you
you can
refinance
go back
into a
and redo your
conventional, you
tax
can do that.
returns, but
Oh yeah. So, but you don't want to do an amendment just to qualify for a loan. The IRS is onto you. Mortgage companies are onto you, and most mortgage companies, if they see that you have amended a return within 6 months or sometimes 12 months, it depends on the lender, they will not consider your mortgage file as a self-employed person, because they might think that you had amended that return for the sole purpose of qualifying for a loan. And the IRS, this is not new. Like, people try to do this all the time. I had somebody,
okay.
if you want a story, I had a bakery owner who came into me, and she was like, okay, I want you to prepare my tax return, but I don't want to have any expenses on there. I'm like, well, you're a bakery. Don't you have flour and eggs and sugar and rent and
Yeah.
electricity and all that? And she's like, well, yeah, but I don't want to show that on my tax return because I'm trying to qualify for a loan. I'm like, okay, that actually might be tax fraud, believe it or not. You might be paying more in taxes there, and it's still fraud. It certainly is on the mortgage side. And so that's definitely murky waters. We want to get, we don't want to do that. And the funny thing is you don't necessarily have to pay more in taxes to have more qualifying income on a loan perspective. And that's one of my most fulfilling favorite things to do ever with the client is to keep their tax liability low or level or minimally higher, but have a rocket boost to their mortgage qualifying income. And that is not a pun. I didn't,
Yeah,
because when we talk about mortgages
that's
and
okay.
rockets, I get kind of stabby. So
Yes, I feel you. Friends don't let friends use online lenders. We all know that. Okay, what do you do, Dan? What are the tips? This
oh
is
man,
it's so exciting.
there's probably about a dozen things I can do to a tax return when I'm doing a consult. And one of those is, yeah, it might include your a higher, income for a little bit here, maybe, but that's kind of the last lever I pull if I have to. Um, so, gosh, how your vehicle is recorded in your business, especially if you're an S corp or not. If there's a way to get that off your credit report or buy it, this is more strategic when you're buying a vehicle. I've got a lot more leeway. Here's how you record it on the tax return. Here's how you get a loan for that. Try to use your business if you can. We might be able to exclude that entirely from your DTI, especially if we use it on the mileage standpoint. I know I'm getting really deep in the weeds here, and so I don't want to go too far, but how you record your vehicle is in there.
I love
If you have
that.
rental properties, how you record those, like the fair rental days matter. If you're doing a cost segregation study in there, that matters too. I know that's not super pertinent to first time home buyers, but man, there's a lot I can do with a rental property. Sometimes the way you have debt on your balance sheet matters. If you have anything in the box that says mortgages, notes, or bonds payable in less than 1 year, that is going to hurt bad when you're trying to qualify for a mortgage because that entire amount will go against your DTI. And five or six things, off the top of my head, I'd have to look at my sheets here, but there's a lot of
Yeah,
things in there where I can, like I said, uh, well, I'm going to mention one more because it's really common and it's a big weapon in my holster is maximizing depreciation and Section 179 stuff. Now, before you turn off your brain because I said something nerdy, let me just talk about what Section 179 is. Say you buy a laptop and equipment with it, maybe monitor and some docks or whatever, and it's $2,400 for that equipment. Now, there's a rule in the IRS that says you can write that off as an expense in one single year using the safe harbor de minimis. Now, it's not going to look it's going to look like an expense on your tax return, which will lower your mortgage qualifying income. However, there's another way to do it that gives you the exact same tax benefit, but leaves your mortgage qualification income alone. And that is using Section 179. It's a little more work for your bookkeeper or your accountant, but you record it as an asset instead of an expense, and you depreciate the entire thing in 1 year. So it's a little bit, tweaky. But if you do that, you
oh,
don't have that $2,400 expense, which means $200 in mortgage qualifying income that remains. If you just wrote it off as an expense, that's $200 a month that your mortgage qualifying income is lower. So if you do it my way, it doesn't go lower. You spent the money, you still get the exact same tax deduction, but your mortgage qualifying income goes up by $200.
that is exciting, Dan. I bought a bunch of camera equipment and crap this
Yeah,
year. So you and I are going to do the taxes. And I mean, again, just as an experiment, well, I don't know. My wife keeps telling me that maybe we want to buy another place. So, maybe I need to be more mortgage ready than I am. The bottom line is what you have done is taken a lot of people come in and ask their taxman to help them do their taxes. And when they do that, they're looking at the now. And they
yeah,
think if I get as much back as I can right now, well, I already put the money in, so I'm going to be okay. It's not about a giant pain or difficult situation. It's just about the presentation of your facts on a tax return so that next year, that's going to be what you present to a mortgage broker. And I know that it doesn't mean that doing your taxes today means you're going to be able to buy a house tomorrow, but most of the mortgages require the last 2 years tax returns. So,
yes.
um, how have you gone deeper into this? Talk to us about your self-employment program that you have.
So what I do, I call it's a consult, and I call it self-employed mortgage optimization plan, where this is a tax consult, and therefore, because you're self-employed, it's tax deductible because this is a tax consult, right? And for right now, I'm offering it for $700, where I go and I look at your tax returns and I say, okay, which of these can I tweak? And also, I am lender friendly. I am not trying to steal any lender's loans out there. I make a larger impact and I make more money, frankly, by being more of an ally. So I want to meet every lender you've got, and I'm mostly a CPA anyway, and that's what I want to do. But anyway, after you talk to your lender, whoever that ends up being, tell me what rates you have for a conventional loan versus a bank statement loan. If they're giving you those two quotes, and then I can run some numbers. Okay, for let's say you have a $500,000 loan, and a bank statement loan interest rate would be 8.25, and a conventional loan rate would get you 6.75. You're going to
Okay.
save $500 a month on your payment. And so,
Yes.
as a part of that, maybe as part of my consult, maybe your taxable income goes up a little bit, maybe not, right? I gave you some examples where it didn't have to, but if it
Yep.
does, if that's what it takes, I run an analysis as to, okay, if you pay more in taxes, let's measure that and balance that out against the higher mortgage interest rate or the lower one, and see which one works out for you. Because if you're going to pay higher taxes than you are the interest rate savings, like, don't do it, right? But you'll have the information to know which one is going to be better for you financially. And so I go over all those things. I talk about Section 179 stuff. I talk about business age and making your S election, personal expenses, vehicles, non-recurring expenses, home office. There's a whole bunch of things in there where I can coach you that for spending the exact same money, I'm going to make you look better to a mortgage lender and probably keep your taxes level, if not minimally higher at worst, so that ultimately the end result is either going to get you to qualify for a conventional loan, which is much better interest, or prepare you for somewhere in the next 1 to 2 years to do that.
So the way it works for the homies out there is, if you're self-employed, you go to a lender and you show them your last 2 years' tax returns. They're going to come to the result that if you file like this again for 2025, next year you're going to have to take this 8 point something bank statement loan,
Right.
most likely, because you can't right now qualify for this 6.75 conventional loan. But by having the discussion with you and doing, well, what did you call it? I wrote down CMOP.
Yeah, self-employed mortgage
Self-employment,
optimization plan. Yep.
self-employed more CMOP. So they go to you and they do a CMOP, and you say, hey, maybe next year your only option isn't going to be that 2 points higher, because we can do all that laundry list of stuff that you just said. Is that how it works?
And it's very friendly with CPAs. If your CPA looks at it and says, I don't know what the crap he's talking about, I have a network of my own to do that. And
Okay.
capabilities of my company. If, like, hey, my CPA doesn't like to be told what to do by another CPA, whatever, great, I can help you with that. Fine. Again, I like to make friends in all my industries. I think it raises all boats, rising tides, right? And so I would
Yeah.
love to be introduced to your CPA to talk about this, or to your mortgage lender. I want to be an ally, because what I'm offering here is good for, I think, everybody, really, because it makes everybody happy, including the IRS and the lender and the CPA. Like, they're going to look like rock stars, and I want to be a part of that.
The reason why I was so excited to have you on the show and talk to the homies is because, I mean, as you guys know out there who listen to the podcast, I don't have very many guests on the show. When I read your book, it was so incredible what you and your brother did to help break down the financial benefits of home ownership. I'm going to help them a lot with the hows, how to search for a home, how to find the right realtor and lender, and, going through your inspections and appraisal. But a lot of people are still stuck on the math.
Yeah.
And I know that a large part of your business is helping people who have investment properties.
Yes.
And what was so cool to me is it was like you kind of looked at all these people you were helping with investment properties, and you saw the same hole I did, where it was like, yeah, but people got to get their own home set up first. Then I can help them with the rest. So this self-employment mortgage optimization program, your CMOP, is just kind of an extra little of labor of love that you're doing, because, you saw that the self-employed people weren't really getting what they needed. And
Especially first
so,
timers.
oh yeah,
Yeah, especially first time home buyers. I mean, yeah, their taxes would fall into a black hole because their lender said, "Hey, your tax returns made you look like you made way less than you actually did. Come talk to me after maybe, after they look better."
oh my gosh, I just thought about something. That's hysterical. One of my good friends from high school just called me up the other day, and homie's exactly like your 200, showing 50. It looks, making 200, but shows 50, and him and his wife want to buy a house. And so he needs a CMOP. So I'm going to have my buddy call you.
Lovely.
I can't just thought of that right now because he just left me a message this morning. It's so exciting to be able to, for you. So for you and what you're attempting to reveal to these people is just to see that they may have options. It might work out or it might not. So what's the process when they come in and someone wants to talk to you and say, "Hey, give me an evaluation"?
Well, first of all, we just have a conversation to see if we're a good fit, right? And I'm very honest about whether it is or not. If they don't make enough, they make $50,000 according to their tax return and their bank statement. That's probably not going to get very far in most parts of the country. Yeah, maybe depending on where they live in the Midwest or the South, that might get them somewhere. But first of all, we see if it's worth it for you to pay me to even do this. As far as, okay, are you even in a position to buy a home? And usually, if they haven't talked to a lender, we can, I've got a network to help people with that. But preferably, they've talked to a lender first, and we can, determine, okay, are you within striking distance, either now or within the next couple of years? Because to your point, most lenders will want 2 years of tax returns in order to get there with a conventional loan. So that's first what we do is we just have a conversation. And if we determine that, I'll run some quick math first to see, okay, tell me what he quoted you on a bank statement loan, and then tell me what if you could qualify for a conventional loan. Then I run the math and say, okay, here's what the difference in your monthly payment would be. Is it worth it to get there? And can we get there? That's kind of the next thing. And then if they engage me, then yes, I'll want to see their last 2 years of tax returns, maybe one if they've been in business for 5 years or more. And then I do my magic there. You pay me the fee to do that. And by the way, it is incredibly dwarfed by what I'm going to save you. Like I wouldn't offer this service with with a clean conscience otherwise. And maybe, like I say, I'm looking at my math right now. And if you just keep that mortgage, that $500,000 mortgage for 10 years, then the difference is 6.75 for conventional versus 8.25. So just a percent and a half difference. You're going to save $61,000 over those 10 years in having that lower interest rate. So if you want to pay me $700 to save $60,000, maybe I'm your Huckleberry.
Well, I heard what I heard and what you just said right now that was really, it just brings you into the how to buy a home family is that you will talk to someone. It's not, hey, pay me $700 and we set up a phone call.
Right.
It's set up a phone call and let's see if I can help you.
Exactly.
Very much like I've got the unicorn realtors who aren't trying to sell them a home this month. It's let's see where you're at today and then let's help you make a plan. And with you as the unicorn CPA, people can reach out to you and find out if this is something that makes sense for them. And if it does, then we go to the next steps.
Exactly.
And beyond that, you're not even trying to then be the lender on that. You're just helping them with this. And, for those of you out there going, wow, this sounds too good to be true. I'm telling you guys, go read the book or check the notes and see if we've got the link for the audio book yet by the time this podcast comes up. Because Dan and his brother, they are so all about just the joy of understanding the financial benefits of home ownership and realizing that as life goes along, our businesses are going to grow when people reach back out to us for other things. Dan specializes with people who have multiple rental investments. I want all you homies to buy your first home. And if you're done there, awesome. But if you then go on to try to grow your empire, Well, now you've got a team of people behind you that have your best interest at heart first, and now can help navigate. Because you think we got nerdy about this. Boy, the tax deductions on rental properties, that stuff. Dan,
Don't get me started. I will not shut up.
Well, here's what we're gonna do. I'm gonna put a link in the show notes for people to get directly to you if they want to have their CMOP consultation. That's your self-employed mortgage optimization programming, and it is only something that you take advantage of if you and Dan together see that this is a potential to possibly set you up for $500 a month savings in the example that we gave. And then I'm also going to put a link in the show notes for where to get the book, both on Amazon, and then hopefully by the time we put this up on audio as well. This is such an exciting interview. I am so honored and privileged when I find people out there that have your best intentions at heart. People that are really trying to help first-time home buyers, trying to lift you up and get you in the game. There were so many great things in that interview. If you've got questions, there's going to be a link in the show notes. Just click on that. You'll go to the How to Buy a Home website and you can hit Ask David anytime and say, hey, I want to talk to Dan the tax man. If you're a self-employed person, or if you're someone who just wants to have a different set of eyes, somebody who's really looking at the tax benefits for you in terms of being a first-time home buyer, attempting to make this happen so you can accumulate wealth. Thanks so much for listening, gang. Keep going. Keep working your plan. Make sure you're lining yourself up with the right pros. You can do this.
Looking for more DIY education or your own personal step-by-step guidance through the home buying journey? Since 2019, How to Buy a Home has been the #1 resource for first-time home buyers. So visit howtobuyaHome.com to get started.